Pay zero capital gains tax on real estate sales. 3 proven methods. In this section, we will explore how you can avoid paying capital gains tax on real estate sales through 3 key strategies. These strategies allow you to navigate the complexities of real estate tax laws in a way that minimizes or even eliminates the tax burden associated with selling investment properties. Footnote: this section outlines 3 legal methods to avoid capital gains tax on real estate transactions. 1. Depreciation and recapture. When you own an investment property, you are allowed to take depreciation deductions over time. This reduces your taxable income by accounting for the property's wear and tear. However, when you sell the property, the IRS requires you to recapture the depreciation, meaning the amount you deducted during ownership is added back to your gain for tax purposes. Although recaptured depreciation does not count as capital gain, it is taxed separately. To avoid paying capital gains tax on depreciation recapture, you may utilize other strategies. Footnote: depreciation recapture must be accounted for when selling investment properties, though it is not considered a capital gain but taxed separately. 2. The 121 exclusion. One of the most effective ways to avoid capital gains tax on a primary residence is through the IRS's 121 exclusion. Under this provision, if you have owned and lived in the property for at least 2 of the last 5 years, you can exclude up to $250,000 in capital gains if single, or $500,000 if married. This exclusion applies only to your primary residence and is not available for properties you rent out or use as vacation homes. If your home appreciates in value, this exclusion can result in zero tax liability on the capital gains from the sale. Footnote: the 121 exclusion allows homeowners to avoid paying capital gains tax on the sale of their primary residence, with limits based on marital status. 3. Utilizing the 0% tax bracket. Another way to legally avoid capital gains tax is by taking advantage of the long-term capital gains tax rates. For certain income levels, the IRS applies a 0% tax rate to long-term capital gains. If your total taxable income is below the threshold for the 0% capital gains bracket, any gain from the sale of property may be completely tax-free. For example, if you are a retiree with a relatively low annual income, and you sell a property, the gains from that sale may not be subject to taxation. Footnote: seniors and others with low taxable income may qualify for the 0% long-term capital gains tax rate, making the sale of property tax-free. 4. 1031 exchange. A 1031 exchange allows you to defer capital gains taxes by reinvesting the proceeds from a sold property into another like-kind investment property. This is particularly beneficial for real estate investors who wish to avoid paying taxes on the appreciation of their properties. The IRS has specific requirements for a 1031 exchange, including timeframes and rules on identifying replacement properties. By continuing to reinvest the proceeds, you can defer taxes indefinitely. If you pass away and your heirs inherit the property, they inherit it at a stepped-up basis, effectively eliminating the capital gains tax. Footnote: the 1031 exchange defers capital gains tax on investment properties by reinvesting in similar properties, providing tax advantages for long-term real estate investors. Conclusion: how to legally avoid paying capital gains tax on real estate. Understanding how to legally avoid paying capital gains tax on the sale of real estate is an essential strategy for property owners and investors. Whether you take advantage of the 121 exclusion, leverage the 0% tax bracket, or utilize a 1031 exchange, these strategies allow you to manage your capital gains effectively. By employing these methods, you can ensure that your property sales are as tax efficient as possible, helping you retain more of the profits. Footnote: strategic use of tax laws can significantly reduce or eliminate capital gains tax on real estate transactions.